Three of us here, about to be joined via telephone by a fourth. We welcome you back to America's Forum. I'm J.D. Hayworth.
And I'm John Bachman. Newsmax TV host Ed Berliner is with us as well. Also joining us via Skype is Peter Schiff.
Stand correct. We got that all fixed up. Good.
That's right. We had some technical issues. You appear to have those worked out. But a tough day on Wall Street on all the indices. The Dow Jones, the S&P 500, and the NASDAQ all down sharply today. Some analysts are concerned that these losses could be a sign the bull market may finally be coming to an end.
And it's a logical question to ask with our next guest, Skyping in, Peter Schiff, CEO of Euro-Pacific Capital. Peter, it is great to have you back with us on America's Forum.
Oh, thanks for inviting me back.
Peter, one of the things that I found was interesting, a report I saw in Barron's which said gold was among 2013's most unloved categories. Excuse me, I thought gold was always loved. So what made it so unloved, and why are so many investors saying it may not come back in 2 weeks, but in 2 years it's going to be a pretty darn good investment?
Well, you know, most people on Wall Street don't like gold. I mean, they loathe it. They want people to think everything is great. They want people to have confidence in paper and the central banks, and you know, they want to sell stocks and bonds. So gold is never loved. The fact that it was loved briefly, maybe in 2011, 2012, some people on Wall Street reluctantly embraced gold, but they quickly fell out of love with it the second half of 2013, which I think has set the stage for a great rally, because so far in 2014, gold is doing a lot better than stocks.
What is it that's driving gold, or will drive gold here within the next, let's say, 6 months?
Well, it's the same thing that's been driving it for 13 years. It's inflation. Central banks around the world, particularly the U.S., are going to continue to create more and more inflation. In fact, now the central bankers don't even pretend that they're fighting inflation. They are fighting to create inflation. They're telling us that inflation is a good thing, that the absence of inflation is a problem that the Fed has to solve. And so if we have interest rates at zero and you have the central banks guaranteeing that if you hold on to the paper they're printing that you will lose money, that is a great environment for gold, and gold's going to find more and more support as long as the central banks are printing.
Well, so one of the things driving gold, Peter, in the recent weeks is this geopolitical strife between Russia. A lot of folks like to use gold as a safety play when there seems to be some trouble out there in the global economy. But what you're saying here is that this is not a reaction to geopolitical problems. This is really intrinsic with what's wrong with the global economy, and that the gold is a better long-term play here.
Yeah, well, first of all the gains gold has made thus far this year happened before the events in Crimea. Ever since the Crimean invasion, gold's actually corrected. So for somebody to say that gold has rallied because of Crimea, they're not paying attention to the market. The Crimea event was a catalyst for a pause in the gold rally, which I think will resume. I think the recent weakness in the stock market will ultimately be good for gold, because it may in fact be the catalyst to get the Fed to back down on the taper talk, to maybe pause the taper in anticipation of a reverse course and a whole new round of QE. One of the things that took the wind out of gold sales was the false belief that the Fed was going to end its QE program. I never believed that. I think they're going to ramp it up to an even higher level.
Well, Peter, let me ask you this question. Much has been made of the new book by Michael Lewis, and CBS 60 Minutes a week ago Sunday had the story about the ultimate insider trading, inside trading via the internet, delaying or short-circuiting orders and having time during that delay of seeming nanoseconds to up the price, to change things, to manipulate the market in that fashion. When you have those allegations out there, and just late last week we heard Attorney General Holder say that he was going to take a look at that, what happens to the confidence in terms of trading, in terms of stocks, whether it's the New York Stock Exchange or internationally?
Well, I don't think that has anything to do with the recent weakness in the stock market. You know, the stock market is going down because A, it's overvalued, and B, the Fed is tapering the quantitative easing. It's the quantitative easing that is responsible for the sky-high stock prices, and as the Fed tapers back, the market is going to come down until the Fed cries uncle. Because remember, the whole basis for the taper was the wealth effect of higher stock prices and real estate prices on consumer spending. Well, if the wealth effect goes into reverse, which it will do if the Fed keeps tapering, then the recovery vanishes and the Fed has to come back. But, you know, people have a lot more to worry about than these flash traders are paying an extra penny or two when they execute their trades. I mean, maybe the flash traders are driving up costs a little bit, and maybe the market has a solution to that. But when I got started as a stockbroker, they were trading stocks in eighths. That was 12.5 cents was the smallest spread you had. So right now, even if the flash traders are scalping a penny or two, investors still get a much better deal now than they did back then. I mean, maybe it's a problem for the day traders, but for the long-term investors, it really doesn't matter. What matters is what they're losing to the Federal Reserve, that the Fed's got the market manipulated with cheap money, that inflation is destroying the real value of our returns. We need to focus the problem where it really is, on government, on the central banks, not on some of these computerized trading programs. That's the least of our worries.
Peter, about the minute or so that we have left, you use the word government in there, and you also use the word recovery. All right, I'm going to focus on recovery here and words from the government. There are people who say that when the government says the U.S. economy is staging a robust recovery, that it's simply a lie, it's fiction, there's no truth to it. If indeed that is true, how are they getting away with it when you just should have the facts right in front of you?
Well, they get away with it. There's a vested interest among a lot of special interests on Wall Street, in government, to perpetuate this myth. And so that's what they're doing. But as I said, you know, the Fed has always had these robust economic forecasts of a U.S. recovery that never pans out. This time isn't going to be any different. Right now, they've been blaming the weakening data on the weather. Well, as the spring progresses and the economic data continues to deteriorate, they're not going to be able to pretend it's the weather anymore. When you throw in weakening stock prices, a weakness in the real estate market, the Fed is going to be forced to admit that the recovery that they're hoping to achieve is still eluding us, and they're going to say that we need more stimulus. Of course, that's the last thing we need. The reason the economy is still so weak is because the Fed is stimulating it, but unfortunately, the Fed is not going to learn that lesson. We're going to get more stimulus, which means the economy is going to get a whole lot weaker. Inflation is going to be a much bigger problem than it already is, and the gold prices, which we started talking about earlier in the interview, are going a lot higher.
All right, there you have it from Peter Schiff, Euro Pacific Capital. Now might be the time to buy gold, but as we say on the show, free investment advice is worth the price.
And we can also say this: we love to have your comments. To us, they're priceless. Reach out to us via social media. Tweet us your comments at Newsmax TV, #America's Forum.